So record highs in gold, that is a bull market, right? Bull markets keep making record highs. The gold stocks are all in bear markets, right? They all dropped more than 20% from their highs, and they haven't recovered. So they're still in bear markets. So you have gold at all-time highs in a huge bull market, yet you have the gold mining stocks that should be the primary beneficiaries of the gold bull market, and they're all in bear markets. What does that tell you, right? Investors have got everything wrong, right? They're buying what they should be selling, and they're selling what they should be buying. The market's going to explode, I think. I think we're getting ready for it. Nobody's talking about it. Nobody's paying attention to it. But the fundamentals are great. Certainly, the gold stock investors are not paying attention to it, even though the gold stocks had a good week.
How are you going to kick the can down the road from this one? This is too big. It's a tsunami, which is going to completely wipe out markets, in my view. Normally, I would expect silver to rise at about twice the rate, maybe slightly less than twice the rate that the gold price does. And it hasn't.
That's because they're the ones accumulating it. And at some point, we see the price setting move from the COMEX, move from the LBMA to places like Shanghai.
I think the only monetary asset that will stabilize the world system and provide for a stable monetary system is gold. And why is that? Well, because it's been used for thousands of years to do so. Bitcoin doesn't have the track record. It's not widely recognized, and it's not in the human psyche as gold is. Even Trump.
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pin comment. Stay ahead of the curve. Don't miss out.
Story on the week was the U.S. dollar, gold. Nobody's really talking about that. The dollar index was down for the second week in a row. And this week was a big drop, about 2% drop in the dollar index. Now, it's still pretty high in the scheme of where it was before Trump was elected. We're about 107.5, but we got above 110 last week. So we're about 2.5% below the high. The euro is back at like 105 after being, I think, slightly below 102 when it hit the low. But we'll see what happens next week. I think if we get another drop next week in the dollar, I'll be pretty confident that we've seen the highs. And this whole move up in the dollar was a gigantic head fake just to get all the traders positioned the other way before they get the rug pulled out from under them. And that's what I've been expecting. Also, gold. Gold today, after hitting record highs just about every day this week in terms of the euro or the pound or the Canadian or Aussie dollars and a lot of other currencies, gold was going up. And it came to within $10 today, maybe even $7 or $8 of an all-time record high. We got up to just about 2,790-ish. And that's about the record high, maybe 2791, 2792. So we almost got there. And in fact, gold closed today at 2771, or for the week. That's about $20, less than 1% below its all-time record high. Up 2.3% on the week. So about the same percentage as the Dow. But again, record highs in other currencies. Silver was up 1.4% on the week, not as much as gold. And it's still below $31. I think it closed around $30.60. That's the buy. You can certainly keep buying gold. It's going to go higher, I think. But if you don't want to buy at the all-time highs, which is basically where we are in gold, now the chances are these aren't going to be the all-time highs for long. And so most people who buy gold are going to be buying near the record highs because gold's going to keep rising. But again, it's not gold that's rising. It's fiat currencies that are falling, and they've got a long way to fall. So therefore, the price of gold in terms of those currencies has a long way to rise. But silver is what everybody should be buying right now, I think. It's a steal. below $31. I mean, I think 30 is a support. I mean, it can get a little bit below that, and we've done that, 29 and change. But I mean, this is, I think, about as good as it's going to get in the silver market. People should be buying it.
Answer, but this is fundamentally a dollar-based bubble. Mm-hmm. The reason it's a dollar-based bubble is that the dollar is the reserve currency of everybody. It is the international trade currency. It is the international commodity settlement currency. It is the international currency, full stop. So we see the dollar going higher and higher, higher, because people are now waking up to this interest rate problem. Gradually, I mean, there's still a lot of waking up to do. It's undermining the other currencies. Mm-hmm. We now get to a situation where, as I suggested, if we see the 10-year maybe go over 5% yield, which I think it will do in the not too distant future, then I think that will take the equity market out. Then, of course, all the debt problems in other places will start being triggered as well. Bear in mind that the G-SIBs in both Japan and the Eurozone have debt to equity ratios, in some cases, of over 20 times. Now, that is exceptionally high, and that's come about principally because of negative interest rates. I mean, the only way in which a bank could protect the bottom line was increase its gearing, because the lending margins were just getting compressed and compressed and compressed. So that's what they did, and they're now left with this sort of enormous debt to equity levels. In America, I guess it's around about 13.5, 14 times. Amongst the big G-SIBs, this is. Regional banks are a different story. Now, the normal level at the bottom of a cycle, in other words, once all this is sort of washed out and all the rest of it, is for these banks to have debt to equities of around about 7, 8 times, maybe slightly less even. So there's quite a long way to go, as it were, in terms of bank balance sheets adjusting. Mm-hmm. The problem they have is the only way in which the complete banking system can adjust its total outstanding credit is through their customers going bankrupt, because that's the only way it gets wiped out. Some of it, I mean, the difference you've got to sort of understand that money supply is actually sort of a secondary consideration in this, because money supply is distorted by flows between the commercial banks and the central bank, because central bank, the deposits, if you like, the reserves, as they call it, which are really commercial bank deposits at the central bank, are not included in the money supply calculation. So, banks can increase their reserves, and that undoubtedly is going to happen, because the Fed will go in there, it'll have to buy bonds, because the foreigners and everybody else on the margin isn't going to want to buy anything other than very, very short-term debt. So at some stage, we're likely to see QE come back. Now that will contract money supply, because what happens is it doesn't destroy the credit; it just migrates from commercial banks into the Fed. Other than that, the only way in which this credit gets destroyed is basically when through defaults. So that's going to happen big time. Now, the value of credit, the total value of credit, will diminish, because you will have losses booked to, sort of market losses on the value of credit. And that is really the way the adjustment is going to happen. It's going to be mark to market, if you like, in terms of looking at equities, in terms of looking at other financial investments, if you like. And as far as gold is concerned, of course, it will lose mark to market value. I'm talking about the currency losing mark to market value against gold. So this is why gold appears to be going up. It's not. Gold over long periods of time, going back even to Roman times, the prices in many things were really quite similar. There is some fluctuation, yes, but it's pretty minimal. Like it might double or it might halve, sort of thing. This is individual things, but basically, if you have a sort of a broad-based index of everything, measure it in gold, I mean, it doesn't change. Mm-hmm. What does change, and this is where everybody gets it wrong because they account in these paper currencies, what changes is actually the value of the paper currency. And this is why when we see gold going up, it's really reflecting the fall in the paper currency. But because so few people realize this, they will begin to realize it at a later stage. I mean, the thing that's fascinating is if you look at ETF demand, if you like, as a measure of sentiment in Europe, ETF demand for gold ETFs, physical gold ETFs, is pretty much negative in Germany. I mean, it's just not increasing. Also around Europe. And if you talk to the retail markets, and I think this is also true in America, you find that people who are hard pressed are selling gold and silver coins because they got to put bread on the table. There's a lot of that going on.
You look at the amount of silver that India's imported, almost 900 million ounces in the last 4 years, as you mentioned. Russia making it part of their strategic stockpile. China is gone from a net exporter to a net importer. They're flying all around the world to Peru and to South America in particular, disintermediating the market and buying directly from the miners. They're buying doré bars, which are a crudely refined bar, maybe 40-50%, before it gets sent in for further refinement. And they're buying concentrate, which is like a sludge byproduct of the mining and the refining process, and sending it all home, paying double what the West will, and having it refined further in China. 77% of all of China's industrial uses of silver is coming from concentrate that they buy directly from the miners, which disintermediates the marketplace. No one knows how much they're getting. It doesn't affect the price. They're the second largest producer of it in the world as well. And here we are again. We'll have a 280 million ounce shortfall this year again, which is the fourth year in a row over 1 billion ounces short. It's a structural deficit that's not going away. You had 47 million ounces delivered off of COMEX in December. Who's taking that? Where's it all going? On the LBMA right now, you have 800 million ounces. It's the lowest position they've ever had because of that 800 million, 500 million belong to the ETFs. That leaves a float of 300 million ounces. They trade 290 million ounces per day on the LBMA. They trade the entire float. However, they admit to the fact that that trading is 10 times understated because they only post the final settlement numbers, which would mean they're trading as much as 3 billion ounces of silver per day, which is 3.5 times annual global mine supply. They have a 300 million ounce float against between 4 and 6 billion ounces short naked. 90+% of all of those short trades are naked, meaning there's nothing behind it but stupid commercial banks' ability to continue to suppress the price. And that's something that I think needs to be understood because what it is a powder keg waiting to happen. And whether it be a delivery failure or a force majeure, on COMEX, silver is rehypothecated close to 2,000%, meaning 20 people hold a 5,000 ounce contract. If every one of them stand for delivery, one will be lucky to get the metal. The rest would be cash settled or force majeure. You have military industrial complex that needs silver. It is omitted in the supply demand numbers. If you Google H.2768, I believe is the number, that was a congressional hearing in 1942. Where they basically they're talking about using silver for war purposes, and they said at the present rate we're using 200 million ounces of silver per year for military. That doesn't take into account the aerospace and the ICBMs. All of these super high tech military applications need copious amounts of silver. So take a step back and ask yourself, why would 8 commercial banks be stupid enough to have the largest concentrated short position in any commodity ever traded in the history of COMEX on silver? Why would those same banks be short between 4 and 6 billion ounces of silver in London off of a 300 million ounce float? Because they're stupid, number one, as stupid as a mud wall, and number two, they're being told by very powerful people, in particular the military-industrial complex, to keep the price low because they need it to make high-tech weaponry to sell all around the world. That's why it's happening. And the difference now is that the countries like China and India and Russia are not only coordinated and sophisticated, we see the price setting move from the COMEX, move from the LBMA to places like Shanghai, where, by the way, Pierre Lassonde said the price ultimately will be priced in the East, not in the West, when the volume on Shanghai surpasses COMEX. Well, just recently, the Shanghai Metals Exchange and the Shanghai Futures Exchange combined volume is greater than that of the COMEX, making it number.
I think the only monetary asset that will stabilize the world system and provide for a stable monetary system is gold. And why is that? Well, because it's been used for thousands of years to do so. Bitcoin doesn't have the track record. It's not widely recognized, and it's not in the human psyche as gold is. I mean, even Trump in his inaugural speech said we're entering the golden age. It's always about the golden child or the golden whatever. It's not about Bitcoin. It's in our DNA. But let's get back to Judy Shelton and see what she says here. And I'm quoting now, "If heads can nod in agreement that central planning does not work, it opens new policy avenues for revamping the process that enables central banks to manage whole economies. Why allow a small committee to set the price of loanable funds? If we can likewise agree that stable money fosters productive growth, we can proceed to question existing monetary policies and practices that encourage financial engineering rather than productive growth." The rivalry between the USA and China, there's a lot of talk about that China wants to take over as the major power, but I'm going to step back and look at things differently, and I guess that's why I'm the home of alternative economics and contrarian views. And I have to admit, it's very difficult to know really what's going on underneath the surface. But sometimes you have to try to look from 33,000 feet, or look at the whole forest, so to speak. And I'm seeing more and more signs and pieces of the puzzle that make me believe that the USA and China are preparing the world for a new monetary and trade order. Yes. Why would the two biggest rivals in the world sit together and come to a deal? Well, because it's the only way the world can keep going peacefully and with prosperity. If you've got the two most powerful nations in the world economically, let's say militarily as well, and trade-wise, sitting together and agreeing to something that changes the way things are right now, that will be very powerful. That will force everyone to go along with it. And you might ask, what about BRICS? What about the G7? Aren't they rivals? Yes, they are rivals, but I think the point of BRICS is for China to help the let's say, Western countries with these negotiations that are going on behind the scenes. And you might say, well, but we're hearing this and this and that. How can you say that? Well, I think a lot of the stuff we get for public consumption is just that. It's trying to keep the public in the US, the public in the UK, in Europe, or in China, or in Russia, behind their governments. But behind the scenes, they're actually trying to fix things. And why do I say that? Well, the major reason, I think, is because of the fact that the world's monetary, financial, economic system is on its last legs, that is just insurmountable, and something has to replace it. And it's a big, it's a big job to do. It's something that has to be done as as appropriately as possible, because it's really important. It will have to last at least a century, I would say, or even more, to keep the world peaceful and prosperous. Yes, and it might sound a little bit idealistic, but I think that's what the powers that be want. I don't think... What I think Trump signifies is that the old guard wanted to keep the old system going, but the people decided that they wanted Trump. They wanted something new. And that actually aligns with what the Chinese and the rest of the world wants to do, in my opinion. A new monetary, financial, trade architecture for the world, because the fiat-based, debt-based derivatives, Babylonian system that we've had really since 1933. You could say it's since 1971. That is on its last legs. And I think Mr. Trump and his team, especially Scott Bessent and also Judy Shelton, who's working probably with the Trump administration, and we're going to come to this book in a minute. They're all working to fix this, to get the world back on its feet. I think in terms of an honest system that's not based on financialization. So Bretton Woods, the last time there was a major monetary realignment in the world was at the Bretton Woods Conference in Bretton Woods, New Hampshire, back in 1944. And we went on a dollar standard, if you want to call it that. The dollar was backed by gold, was as good as gold, but all the other currencies weren't backed by gold. They were backed by the dollar, so indirectly backed by gold. That, of course, ended in 1971, and we've actually had a rudderless monetary and trade system since then. So that's what Scott Bessent is talking about here. And the good news in terms of Scott Bessent is that he's been confirmed. It came out yesterday that he was confirmed by the Senate. You can see here that Make Gold Great Again, posted on X. A Goldberg confirmed as USA Treasury Secretary. So we're seeing, of course, a huge, how can I say, wave of tariffs and announcements by Trump. It seems all very disruptive, and it is. And what do I think all these tariffs and threats of tariffs are? Well, I think it's part of this negotiation that's going on, because for 50 years, and especially since the year 2000, and when China came into the WTO, and you can go back a little further into the agreement NAFTA in the 90s, when U.S. opened its market to Canada and Mexico. The U.S. has been offshoring all its manufacturing. We've had a system, monetary system, where there's constant devaluation by all currencies, left, right, and center. There's no, the market is heavily, the world markets, so to speak, is not a level playing field. And I think what Trump is trying to do is take America and the world back to where there's some semblance of a stable monetary architecture for the whole world, so that people can trade fairly. And I think America, of course, yes, it's had a lot of privileges being able to print the major reserve currency, but it's lost out as well in terms of offshoring all its production. It's ruined the middle class. It's created the Rust Belt. So it wants to go back. It's not going to be smooth, but it needs to negotiate with all the different countries. And that's on the trade side, and that's what we're seeing. And, if you noticed, Trump hasn't been as aggressive with China. He said, he was asked the other day about tariffs on China. He said, well, we're not there yet. We're going to wait. And I think it's because the USA and China are going to be the major creators of this new system. What about the EU? Well, the EU is, I'm sorry to say, kind of hopeless. I saw that Trump even said he won't negotiate with EU officials, but he will negotiate with individual European leaders. So he does.